Right now, with the market live and active, Mara Holdings Inc. is trading at $18.26, which is a significant move up of over 5.3% on the day. Volume is already heavy, with nearly 17 million shares changing hands. Now, a pop like this will have many retail investors piling in, thinking the story is simple. Bitcoin is moving, so Mara moves with it. The expectation is that this is just a leveraged play on the underlying digital asset. But the reality, the factor that sophisticated investors using Fidelity Wealth Management or setting up complex orders on interactive brokers are laser focused on, has very little to do with today's Bitcoin chart. The real story is a tense, high-stakes race between operational expansion and shareholder dilution. While the price action provides a temporary sugar high, the company's long-term value is being forged in a much more complex and uncertain environment, and the outcome is far from guaranteed. The common belief, the narrative you'll see repeated across social media and in the comments sections of financial news sites, is that Mara is one of the premier vehicles for gaining exposure to Bitcoin through a traditional individual brokerage account. Traders using the streamlined interface of the Robinhood app or the diverse options on SoFi Invest see a stock that offers explosive potential, a way to ride the crypto wave without dealing with digital wallets or exchanges. And on days like today, that belief feels entirely justified. When Bitcoin shows strength, Mara stock often amplifies that move, providing the kind of volatility that active traders thrive on. This straightforward correlation is the bedrock of the bull case for many, a simple equation that seems to promise significant returns as long as the broader crypto market remains healthy. It is, for all intents and purposes, the dominant expectation. However, if we look past that surface-level assumption, a more complicated and arguably more important reality emerges. The institutional money, the kind that moves through Fidelity investments and influences the holdings of major ETFs, isn't just buying a Bitcoin proxy. They are analyzing an industrial-scale mining operation, and that involves scrutinizing factors that the average retail trader might overlook. The primary tension point is the constant need for capital. Expanding a Bitcoin mining operation to the scale of Marathon Digital requires a colossal investment in new generation ASIC miners, data center infrastructure, and, most critically, securing massive amounts of low-cost energy. This expansion is funded, more often than not, by issuing new shares. The data shows that shareholders have been diluted significantly over the past year, with total shares outstanding growing by over 25%. So, while the company's total hash rate, its power to mine Bitcoin, each individual share's claim on that growing operation is shrinking. This is the critical trade-off that defines the investment. The expectation is pure upside tied to Bitcoin. The reality is a constant battle where operational growth is financed by diluting the very investors who are hoping to benefit from that growth. Looking at the recent stock movement, this tension is palpable. The daily swings are not just a reflection of Bitcoin's price, but also of market sentiment regarding the company's operational execution. A strong day like today, with a 5% gain, is often driven by a combination of a rising crypto tide and perhaps some positive sector news. But we've also seen sharp downturns on days when Bitcoin was relatively stable. These drops are frequently tied to broader market concerns about energy costs, regulatory headlines, or filings that signal future share offerings. Trading volume on Mara is consistently high, indicating a strong presence of both day traders and institutional players. This creates a volatile environment where the stock can get pushed around by short-term momentum, making it a favorite for those using active trading platforms like SoFi or interactive brokers. Yet, for anyone looking at a longer-term investment, perhaps through Schwab Intelligent Portfolios or a self-directed IRA with Fidelity, this volatility is a double-edged sword. It highlights the potential for rapid gains, but underscores the inherent instability of a business model so deeply tied to a fluctuating commodity and high capital expenditures. The market is constantly weighing the expectation of future mining profits against the present reality of operational costs and dilution. So, what does Mara Holdings actually do? At its core, the company is a digital asset technology firm that focuses on the Bitcoin ecosystem. Its primary business is mining Bitcoin. This involves running vast data centers filled with specialized computers known as ASICs that solve complex mathematical problems. By solving these problems, Mara helps to secure the Bitcoin network and process transactions. As a reward for this service, the company receives newly created Bitcoin. This is the fundamental engine of its revenue. The company operates on an institutional scale, positioning itself as one of the largest publicly traded Bitcoin miners in North America. Its strategy has been aggressive expansion, continuously purchasing the latest, most efficient mining rigs to increase its hash rate and, consequently, its potential Bitcoin production. Furthermore, a key part of their business model is not just to mine and immediately sell, but to hold a significant portion of the mined Bitcoin on their balance sheet, viewing it as a strategic treasury asset. This HODL strategy makes the company's balance sheet a direct reflection of Bitcoin's value, further cementing the market's perception of it as a crypto proxy, even as the operational realities tell a more nuanced story. This dual identity, part technology operator, part Bitcoin treasury, creates a unique but complex profile compared to more traditional investments like Apple stock or even a high-growth tech play like Nvidia stock. Looking toward the future, the disconnect between expectation and reality will only intensify. The next Bitcoin halving event is a major catalyst on the horizon. The general expectation is overwhelmingly positive. Historically, halvings, which cut the reward for mining a block in half, have been followed by significant bull runs in Bitcoin's price. The narrative suggests that while revenue per block will decrease for miners, the corresponding increase in Bitcoin's price will more than compensate, leading to higher profits. The reality, however, is that the halving is an extinction-level event for inefficient miners. It dramatically raises the cost of production overnight. Only the miners with the absolute lowest energy costs and the most efficient hardware will thrive. For Mara, this is the ultimate test. Will its massive scale and technology investments be enough to maintain profitability when the block reward is slashed? The risk is immense. If Bitcoin's price doesn't appreciate significantly and quickly post-halving, Mara's profit margins could be crushed, potentially forcing them into even more dilutive financing to cover operational costs. This is the central question that will define the stock's performance. The company's opportunities lie in its ability to continue securing favorable energy agreements and to deploy its new hardware effectively, driving its cost per coin down. Success in this area would mean it not only survives the halving, but emerges stronger as weaker competitors fall away. The risks, however, are substantial and varied. Regulatory shifts remain a persistent threat, with governments globally scrutinizing the energy consumption of proof-of-work mining. A sudden spike in energy prices could cripple profitability. And, of course, the ever-present volatility of Bitcoin itself means that a prolonged bear market could place extreme stress on the company's finances and its ability to fund operations. Now, I want to hear from you. Comment below what you believe is the single biggest risk for Mara over the next 2 years. Is it the Bitcoin halving, rising energy costs, or government regulation? In summary, the narrative surrounding Mara is deceptively simple. The expectation is that you're buying a straightforward high-beta play on the future of Bitcoin, a convenient option for those looking into online investing or self-investing without the complexities of direct crypto ownership. And while that's not entirely wrong, it misses the entire operational drama playing out behind the stock chart. The deeper reality is that this is an investment in an industrial-scale, capital-intensive, and fiercely competitive business. The company's success is not just tethered to the price of Bitcoin, but is fundamentally dependent on its ability to manage immense operational challenges, from energy logistics to technological obsolescence, all while navigating a financial strategy that relies heavily on shareholder dilution to fuel its growth. The tension between the simple crypto proxy expectation and the complex reality of an industrial miner is what will ultimately determine the long-term trajectory for Mara stock.
Understanding this distinction is the key to moving beyond surface-level speculation and making a truly informed assessment.